Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll break down how to trade the market volatility after stocks drop following that massive one-day rally. The options trades to watch ahead. Plus, despite a pause in some tariffs, the U.S.-China trade war is just heating up. We'll break down what it means for investors and the tech trade later this hour. And the Fed's inflation problem looming as tariffs are set to hit prices following a better-than-expected CPI print. We'll discuss how the central bank is balancing its dual mandate amid the growing trade war. Half an hour into the start of U.S. trading, we're back to a risk-off mood in the markets. Taking a look at your major averages, you've got your S&P down a little over 2.5%, but tech taking the brunt of the losses this morning, down about 3.5% in your S&P. By the way, the only sector that is up at the moment is consumer staples. Even utilities in the red right now, though just below the flat line. You can see tech as one of the biggest losers in your S&P. But let's take a look at the bond market, because this is where we are seeing fascinating movement, especially in the front end of the yield curve coming in here. You've got your 10-year yield also moving to the downside. We've got a 30-year yield auction later today. A little bit of a gift for investors heading into that auction, that we are seeing the 30-year yield coming in just a bit, down 4 basis points this morning. What does that mean about how bond investors are viewing the Fed put moving forward, and also concerns about economic growth and inflation? We'll talk about that throughout our program. But lastly, I do want to take a look at Bitcoin moving to the upside in a twist against what we're seeing in terms of risk-off sentiment in your stock market moves this morning. You've got your Bitcoin moving up just about 3.5%. Well, I want to bring in Stephanie Roth, Wolfe Research's chief economist. She's going to join me for the hour. Stephanie, you are one of my favorite economists to speak with, so I'm really thrilled that we have you for the hour, especially on such an important day for the economy, getting in that consumer price index print. Talk to me about your takeaways, because it was a really interesting one.
Yes, it was definitely an odd one. So core came in at 6 basis points. Expectations were that it would be somewhere around 30 basis points, right? So on headline, it was a big miss. Now, the details looked like a little bit of signs of stagflation to some extent. So on the services side, especially within travel, that was weak. You had a big decline in lodging, which is hotels, big decline in airfares. So it tells you that consumers not really feeling great on the discretionary side.
Yeah.
On the good side, there was a little bit of softness in some parts, but then apparel was a little bit strong. Generally speaking, I would say this is the last soft print that we're going to see for a while. And then the goods prices are likely to start hitting in the months ahead.
So whether it was cool for a good reason or cool in a stagflationary reason, does that even really matter, because this print didn't recognize the totality of the impact of tariff policy?
I think the important part that we could take away is that you are starting to see this softness in the consumer. So we already were expecting that to hit in the coming months. I think it's possible that we're starting to see that a little bit sooner than anticipated, which is an important takeaway from the note. And we're going to get a sense from retail sales if that was actually the case, within other pockets of spending as well.
What do you think is driving that consumer softness pre-tariff? What is it that is making consumers pull back already?
Well, I think the equity market sell-off is probably one thing, right? So that gets consumers sort of concerned about the outlook. People are starting to probably save a little bit more, reduce their sort of discretionary spending. And then I think it's probably just the concerns about the outlook, just generally speaking, even not related to the stock market, just those seeing the headlines that are about these looming tariffs, recession fears. And I think this is just going to continue for a lot of this year. Even though we did get the 90-day pause on the country-specific tariffs, there still are a lot of tariffs remaining, which we estimate to be still about 1.5% of GDP.
How are you thinking through the impact of that 125% tariff on China in terms of how that could impact consumer spending? Because a lot of our stuff, like look around the room, a lot of this is from China, right?
So the fact that it was 125 versus just over 100 before, that's probably irrelevant.
Yeah.
In the sense that once you reach a certain point, you're kind of past the point of no return, in which case the concept is a Laffer curve. It's an economic theory that basically tells you that as tax rates rise to a certain point, then your revenues the government revenues that are raised as a result start to come down. Basically, you're taxed so high that you then just reduce your spending. So basically, the tariff rates have gotten so high that we're going to just have to either reallocate from China, or they're likely to just come down at some point. So our imports from China are likely to fall very close to zero if these tariffs remain above 100%.
And how do you think through how that impacts the consumer, especially for consumers who may not be monitoring the headlines every day like we are, and may not be aware of the 90-day pause or things like that? Like to your point earlier, is it past that point of no return in terms of a pull down in consumer spending?
I think it'll depend what happens on the price side and how quickly companies can readjust to some extent. But it's hard to readjust when you don't really know what the policy is going to be in the next 60 to 90 days. So you're unlikely to want to move your production elsewhere if you don't really know if these tariffs are going to persist. So this makes a really uncertain environment, and one that is likely to make it difficult for both businesses and consumers, which is why we're looking for 0.6% GDP this year, 0.6. So not a great outlook. We don't think the economy will tip into recession, but you kind of are close.
You kind of are close, and that's not ideal, obviously, especially if you're an investor, but of course for consumers as well. Stephanie, thank you so much. We're going to keep you here for the hour. You're going to be asking our guests some great questions, so we're excited to have your insights here with us today. But let's continue the conversation. The escalation of the U.S.-China trade war has been dramatic. President Trump raising tariffs on Chinese imports to 54% on Liberation Day, April 2nd, and just over a week later, the levy jumping to 125%. China retaliating with an 84% tariff on U.S. goods. Is there an end in sight for this tit for tat? Joining us now, we've got Rob Casey. He is a partner and senior analyst at Signum. We've also got Eric Winograd, the chief economist over at AllianceBernstein. Guys, thank you both for being here this morning. Rob, I want to start with you because a delay is not a cancellation. What are the next 90 days going to look like, and where will they leave us?
Yeah, thank you very much. Glad to be on. I think that over the course of the next 90 days, of course, we're going to see President Trump's team really working very hard to hammer out trade deals, right? Because he's now, as of yesterday morning, it felt as though he had lashed himself to this pole of we are going to apply the tariffs that we set out last week. Now it feels as though he's lashed himself to the opposite pole, which is we are going to eventually get to these deals, right? This is a delay, given what sounds like President Trump's optimism that they will eventually be able to strike bilateral trade deals. Now, especially with partners like Vietnam and Japan, I think that that's relatively likely over the next 90 days. But with the EU and others, there are intractable disagreements that, frankly, we see as being very, very hard to negotiate around or negotiate through over the next 90 days.
And Rob, how are you advising clients in this moment, and how are you getting clarity on the end goal, on the objective of the president, just to get a sense of where his thinking may be heading moving forward?
Yeah, to be honest, we're telling clients not to rely on a North Star when it comes to what does President Trump want from here, right? There are sects of the President Trump team who are committed to revenue raising. There are folks who are committed to decoupling from China, not only the U.S. decoupling from China, but the global economy writ large decoupling from China. And of course, that there's probably a plurality of President Trump's team who is really committed to bringing manufacturing back to the United States. Now, I think it's important to say that in the short term, these are not, necessarily opposing goals. You can kind of have your cake and eat it too. In the longer term, that's probably not true. So to this point, it doesn't seem like President Trump himself is, operating with a singular goal, a North Star. So what we're telling clients is, understand all of these desires and all of this momentum in each direction, but don't rely on one as a simple or a singular justification for what we're going to get from here.
You mentioned a global decoupling from China. Do you think there's the possibility that the president is likely to try to get other countries to impose tariffs as well? And what might that look like?
Well, I think that if not tariffs, right, I think that President Trump, part of the negotiation is going to be we are uncomfortable with the extent to which China is operating in, X country's economy. So as an example, President Trump applied or, over the course of the past week has threatened to apply and yesterday applied it and then quickly rolled off a very high tariff on Vietnam. And we've heard from President Trump's team that Vietnam may be first in line when it comes to having come to the president and saying, we are ready and willing to negotiate. I think one of those negotiating points could be, I, President Trump, am concerned about China's FDI into Vietnam. We'd like for you, Vietnam, to sort of limit that FDI, to pull that relationship back. We want your, economic and trade relationships to be driven primarily by U.S. interests and not by Chinese interests. And of course, if you're sitting on the Vietnamese side of the table, that's going to be a very difficult pivot to pull off if they want to pull it off at all.
Eric, I thank you for your patience while we were getting some of our policy on with Rob here. Just talk to me about how you are viewing the economic impact of this 125% tariff on China. How are you thinking through the impact that could have on the American consumer, on American companies?
I think Stephanie is right. It doesn't matter if it's 125%, 225%, 2025%. We're at a point now where essentially there will be no goods coming in from China, and that is a dramatic change to the economic alignment. If you think back to the post-pandemic period and the challenges that we had in rebooting supply chains, trying to recalibrate supply chains again without China involvement at all, I think is a Herculean effort that many companies will have to go through, even if in some cases it's something they might have thought about previously. And then to Rob's point, part of the answer in 2018, when the first round of tariffs was imposed, was to reshore and to have Chinese content come through countries like Vietnam. If that's not going to be possible, the challenge gets even greater. So we look at this and think that it does have a significant impact on the American economy, and a significant impact on consumers. We're going to face shortages of goods that currently come only from China, and that's going to be an issue that we have to deal with.
Eric, how do you think about the timing here, in the sense that there's been so much uncertainty? How are companies going to decide to shift their supply chains? Or are they just going to do it immediately because we don't really know how long these 100% plus tariffs are going to be on China, in which case it just makes sense to move out of China regardless?
I mean, I think where you have the capability to do things in more than one location, you'll choose the non-Chinese location for a period of time. But I think it's premature to assume that companies will make durable investments based on a policy environment that has swung dramatically over the course of 7 days, and to say nothing of the changes we've seen over the last 3 months. A big part of what we believe to be the objective of the current administration's policy is to boost investment in the U.S. economy. I can't see that happening in the near term simply because the uncertainty is too high. And I think that the back and forth over the last week has damaged policymaking credibility significantly and may delay that sort of investment still further. If I were a company, and you can think about the automakers here, many of them do have some spare capacity and the ability to run their production lines in the U.S. at greater levels, and I have no doubt they'll do that. But are you really going to rebuild a factory from somewhere else in the U.S. based on a policy that could change at the drop of a hat? The lack of reliability, the lack of a process orientation, and the lack, as Rob said, of a clear end goal here means that it argues for conservatism, and conservatism argues for slower growth.
And Rob, I want to bring you back in here because countries, to Eric's point, countries outside of the U.S. are both afraid of alienating China and of alienating the United States. So if you're advising Ursula von der Leyen later this afternoon after this interview, Rob, what would you tell her about what the EU should be doing next strategically?
Yeah, well, I think the EU is positioned in probably what may be the most difficult spot, right? Because the EU, in terms of the EU economy, ties to the U.S. are incredibly important, probably more important than ties to China. But we also think at Signum that, President Trump, for the most part, has been most antagonistic, at least in his rhetoric, if not tariff levels, towards the EU, right? So I think the EU is a willing partner for the United States, but Trump may not be a willing partner for the EU. So, it's not to say that I think there are some countries who may be, ready and willing to pivot to China if and when they have to. I would not put the EU in that camp. So it really is, if for Ursula von der Leyen and among others, it is going to be a real balancing act. And I would just say, once more, what President Trump is going to ask of countries who want to engage in bilateral talks, I think in particular the EU, may just be too significant to give, right? Trump may overplay his hand. He may ask for the EU to eliminate VAT. He may ask the EU to eliminate, digital services taxes, carbon border adjustment. These are things that the EU can't and probably won't want to unroll over the course of the next 90 days. And I think that's what markets have to focus on is President Trump overplaying his hand in the next 90 days in negotiations? And does that mean that 90 days hence, we are back to this sort of last second uncertainty of whether tariffs will be extended further, that the delay will be extended further, or in 90 days, we're going to have a day just like yesterday morning?
Mm-hmm. Rob, so if the EU can't get rid of their VAT because that is a part of their tax system, what can they actually give Trump? What could a deal look like if they were to give something that would appease him such that they could actually make some sort of deal?
Yeah, so I think you kind of have to broaden the scope. We all have to broaden the scope in terms of what does President Trump want, right? Because there are of course the very specific tariff factors, which I think that probably the EU is willing to give on. There are then the non-tariff factors, again, VAT, CBAM, et cetera. I think it's very difficult for the EU to give on, frankly, any of those. And then there's other, right, non-economic. So that's, I would say, primarily defensive factors, both vis-a-vis US, EU, Russia, Ukraine, right, Eastern Europe, how Europe is approaching that situation vis-a-vis how Trump would like them to. I think that there are also probably bilateral trade deal options that look like ensuring that the EU is making purchases of things like, US defensive products. Of course, we've seen the European defense sector really do quite well, given President Trump's coming back into office. So I think that there are some non, barrier focused trade negotiations to be had.
Rob, Eric, thank you both so much. Really appreciate it.
Thank you.
Fed Governor Michelle Bowman facing the Senate Banking Committee as lawmakers consider her nomination as vice chair for supervision. Joining us now with the latest, our very own Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. Fed Governor Mickey Bowman taking her seat just moments ago before the Senate Banking Committee, where senators will question her to be the Federal Reserve's next top regulatory cop. Bowman will say in her opening testimony this morning, quote, "If confirmed, I will prioritize reforming and refocusing supervision, restoring regulatory tailoring, ensuring a viable path for innovation in the banking system, and promoting transparency and accountability." Bowman will tell lawmakers that bank regulators have become overly complicated and redundant with overlapping requirements, which have increased costs for banks and their customers. She will say bank supervision needs to refocus on addressing core financial risks, an ode to the failure of Silicon Valley Bank, and will look to adopt a tailored approach, especially for community and regional banks. Now, Ranking Member Senator Elizabeth Warren sent a letter to Bowman ahead of this morning's hearing, questioning her on what Warren called her track record of deregulating Wall Street banks and taking a light touch approach to supervision. Warren wrote, quote, "Time and again, you have been proven wrong when dismissing the risks to consumers in the financial system of your deregulatory worldview. Pursuing Wall Street deregulation at a time of broad economic turmoil caused by President Trump's clumsy approach to tariffs would be especially dangerous." Now, Maddie, Bowman is likely to be confirmed by the Senate Banking Committee and the full Senate at a time when Treasury Secretary Scott Bessent has just laid out a very similar vision to Bowman in terms of tailoring regulations for community and regional banks. Back to you.
And Jennifer, we have to get your reporting on the Wall Street consultant Paul Atkins. He was confirmed to lead the SEC. Talk to me about what your sources are telling you about what that means more broadly for the crypto industry.
Yeah, Maddie, just last night, the Senate confirming Paul Atkins to be the next chairman of the Securities and Exchange Commission. And the crypto community, I should say, could not be happier. Atkins is expected to take a much different approach than former SEC Chairman Gensler. He is looking to come up with customized rules to regulate crypto, a departure from what the industry called regulation by enforcement under former Chair Gensler, who had said, we have rules on the books and you need to comply with those. And when companies did not, they were slapped with enforcement action. We've already started to see a lot of that enforcement action being unwound as acting SEC Chair Mark Ueda and SEC Commissioner Hester Peirce have already started laying the groundwork. They have formed a crypto task force in which they have already met twice this year, looking to define what a security would constitute when it comes to cryptocurrencies. So a lot being done with a very friendly regulatory approach when it comes to crypto.
All right, Jennifer, thank you so much. Really appreciate it. Coming up, we're going to take a look at some of the stocks on the move this morning, including Tesla's move into a new market. That's next. It's now time for some of today's trending tickers. About an hour into your trading day, we are watching Tesla's latest expansion to on semiconductors, AI demand, and a message from Amazon's CEO. Let's get to it. First up, Tesla opening its first showrooms in Saudi Arabia, putting aside a long-standing disagreement between CEO Elon Musk and the nation's public investment fund. Back in 2018, Musk had claimed on social media that he had, quote, funding secured to take Tesla private based on preliminary conversations with the head of the fund. The expansion now coming as Tesla deliveries disappointed in the past quarter, and you can see those deliveries coming down here in the latest quarter of 2025. Next up, Taiwan Semiconductor reporting that its first quarter sales were up 42%, its fastest pace since 2022, as customers stocked up ahead of U.S. tariffs. Shares of the chip maker currently down along with the broader market. Bernstein analysts expecting the strong sales to continue into the current quarter, expecting AI demand to remain high. That comes despite some demand concerns after Microsoft cut those plans for several data centers earlier this month. TSMC is set to report its full-year earnings outlook for the current quarter next week. It'll be interesting to see if that outlook stays in place. And we also saw so many of the semiconductor names rallying amid that record-breaking market rally on Wednesday as well. Well, finally, the CEO of Amazon out now with comments on both the company's business and tariffs. In an interview on CNBC this morning, CEO Andy Jassy saying he believes that third-party sellers could raise prices for consumers if they're facing tariffs, saying it depends on the country where they're based, but that he believes they'll try and pass the cost on. And in his annual letter to shareholders, Jassy touting the company's AI demand, saying it's growing at a triple-digit year-over-year percentage, presenting a multi-billion-dollar annual revenue run rate. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. I'm still here with Stephanie Roth over at Wolfe Research. Stephanie, I want to talk to you about a couple of things that we just ran through in terms of the impact on the labor market. Amazon's CEO doubling down on AI growth, revenue moving forward. Is that another zombie that this market is maybe not looking at right now in terms of labor market impact? If we are starting to see an economic slowdown, could we see a quickening of companies replacing workers with AI?
I mean, that's totally possible. That said, this will probably be a longer term story. So there's probably a timing mismatch from those conversations. And by the way, we don't really have that much labor supply anyway, so perhaps being able to automate some of that isn't the worst thing.
But well, let's talk about another potential near-term impact on the labor market, and that is immigration policy. We were just talking about this in the commercial break. Is that something that you think investors need to be paying a little bit more mind to? Yeah,
this is something that's not getting that much attention, and it should be. So it's not about these mass deportation headlines. Yeah, that gets sort of attention, but the real thing is the revocation of visas that are likely to expire in the next 2 years. And not only, and these are basically a rollback of Biden's policies. And rather than just letting them roll off slowly, and we're talking 1 to 3 million people here, rather than just letting them roll off slowly, Trump has ended their visas effectively overnight. So the first hurdle is going to be April 24th, where 500,000 visas from people coming from Cuba, Haiti, Nicaragua, and Venezuela are going to get immediately revoked. So they are no longer able to work legally in the labor market as a result. And then coming after that, we're going to have the program from people coming from Mexico. There's estimated to be nearly 1 million people of them that are also likely to get their visas taken back. So now all of a sudden we've lost nearly 1.5 million people from the labor market. And these are people who are working in largely blue collar type workers, leisure, construction, hospitality. Yeah. And all of a sudden, companies are going to be faced with the fact that they can probably no longer employ a lot of these people.
And even if we do see some of those workers staying in the labor market, they wouldn't necessarily be put in the jobs report, correct?
Yeah, so this is going to be funky for the jobs report. So we're very, very likely to see non-farm payrolls growth come well below 100,000 in the coming months. In addition to just the softness we're seeing in the economy, generally speaking, but also if these people get moved from being legally kind of employed from the employer to being hired under the books, they're going to probably be removed as a sort of as a worker in that industry. Yeah. In which case you're going to see a notable softening that might not even be a reality, but right. I think markets will be paying close attention to that.
Certainly will. Stephanie, thank you so much. Appreciate it. You're going to stick with us for more markets action ahead. Stick around. You're watching Catalyst.
Mag 7 stocks added more than $1.8 trillion in market cap value on Wednesday alone. It was a rip-off-your-face rally for the ages. So let's take a look at some of these record-breaking moves. I'm Jared Blickery, host of Stocks in Translation. First up, let's take a look at what has happened in these stocks this year. So we got 7 stocks, and I've divided the year into 3 parts, and they are definitely unequal. In blue, we have yesterday. That would be April 9th alone, that Wednesday when we had some of the biggest market moves in history in some of these stocks. And then we also have from the February 19th top to April 8th, and that's that big down move. February 19th with the top in the S&P 500 and some of the other indices. And then in white, we have the year end of last year to February 18th, and that would just be up for some and down for some. In the S&P 500, it was a little bit of a rally. So looking at this chart, you can see that first part of the year into February 19th, that really wasn't much. It was just kind of a blip on the radar, these little white spots here, some up, some down. As I said, Meta was the best performer, had those 20 up days. But then when you look at the declines, those were substantial. Nvidia and Apple both saw declines well over $1 trillion over this time period. And you can see some of the gains are a little bit less, but even Amazon down $500 billion, nothing to sneeze at. And then if you focus on the blue, those blue bars, that's what happened yesterday. April 9th, and you can see Nvidia up $440 billion, Apple up $397 billion. The least bullish of these was Tesla, up $162 billion. Nothing to sneeze at here. And a lot of this corresponds to the top 10 days for the Mag 7 of all time. These are the biggest market cap gains single day in history, and Nvidia and Apple are right there. I already went over those 2 moves. In fact, everything in green is what happened yesterday. So 4 out of the top 10 moves in history occurred on April 9th. Now, I also took a look at the worst moves in history, the worst single day moves. And it looks like 1, 2, 3, 4, 5, 6 of those out of the 10 happened this year alone. And that's everything in green that you're seeing. A lot of these happened very recently in April. You can see the biggest of these is a $300 billion decline by Apple on April 3rd, and then it also takes the number 2 spot down over $200 billion the next day on April 4th. You put it all together, it really validates the thesis and the common understanding among investment professionals that the volatility clusters, so some of the best days in history are usually right around some of the worst days in history, and whether or not you want to stick in the market and survive all that, that's a topic for another day. But tune into Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thanks so much. Well, stocks giving back gains after a historic turnaround. The Nasdaq coming off its best day since 2001. Investors now weighing the effects of the ongoing trade war, despite President Trump announcing a 90-day pause on reciprocal tariffs. Joining us now, Tom Essay. He's the Sevens Report founder and president. Tom, thank you so much for being here. Obviously, we have seen a lot of volatility. I wonder how you're viewing both the bond and stock market here. Where are you more bullish right now, stocks or bonds?
Hi, Madison. Thank you very much for having me on. In the near term, I'm more bullish on bonds. I think that yesterday was a pretty important day, and I think that the best way investors should look at yesterday is that it removes sort of the worst case scenario, right? And by worst case scenario, I'm talking about S&P 500 down at 4,000 or close to it, or maybe even below, which were credible cases until we saw the Trump put appear yesterday and that big reversal. It doesn't mean we're out of the woods on stocks, though. There's going to be a lot of concern on growth and a lot of concern on stagflation. That said, I think it does clear the horizon for treasuries, and I would expect yields to generally trend lower in the coming months.
And in terms of the market volatility that we are seeing, how much activity are you seeing kind of on both ends in terms of like short sellers and buyers and where this kind of leaves them at the moment?
Yeah, it's a market that is not for the faint of heart. Let's put it that way, as you guys know. And as far as the shorts and the longs battling, sort of the war has turned in favor of the longs. And by war, I mean not trade war, but sort of the long-term outlook on stocks. Because again, that worst case scenario where the administration drives the economy into a wall appears to be taken off the table at this point. If I'm a short, I am now very nervous, and I'm going to use any declines like we're seeing today to cover those shorts, because at this point, my gains are probably limited given there is a Trump put, and my upside is not over the longer term, as the economy should recover. It may take a while, but it should recover from all of this.
Tom, you talked yesterday about the Trump put. What do you think? Do you think it was more important related to the equity market or the bond market? And then within the bond market, do you think there was something going on with Treasury selling, other countries dumping Treasuries? What was going on there?
So it was starting to sort of break down, and it just underlies how critically important Treasuries are to every single market. And it's not something that regular investors really pay that much attention to. I mean, Treasury trading and Treasury investing is really more for institutions. And because it's always considered the risk-free asset, people use tons and tons and tons of leverage in that market. And when all of a sudden it begins to misbehave, as it did yesterday, and when I say misbehave, I mean start to trade with significantly more volatility than we're used to, then all of those leverage trades begin to break down. That creates ripples. We have seen things like this twice before in, say, the last 20 years. The first was the financial crisis. The other was the beginnings of COVID. Clearly, people have saw something in the administration they did not like in Treasuries, and they pivoted, and that is exactly what they should have done.
So are you concerned looking ahead? You're not really seeing yields rally that much on the back of all of this. How do you think the direction of travel is going to be with rates? Should it go notably lower on the back of slower growth? Should they back up on the back of inflation? What's the direction of travel from here?
So I think that we will gradually trend lower. So I think that the economy is going to slow in the coming months. I'm not ready to say there's going to be a recession. If anything, over the past couple of years, the U.S. economy has earned the benefit of the doubt. But I do think we are going to see a slowing. I think that sort of this idea that the administration is driving us crazily into some sort of depression has been removed by yesterday's actions. And so I think that now we can look at this sort of in a more calm manner. There is going to be an economic slowing. You can't just sort of pull these levers willy-nilly and expect nothing bad to happen in the economy. But I don't think it's going to be anything that would cause the removal of confidence from Treasuries. So I think we gradually drift lower in Treasuries. I think that the yield is safe. I think that if you are looking for somewhere to hide, that long-term U.S. Treasuries remains, and once again, a good place to do so.
So it sounds like you're not concerned about foreign demand being utilized as a tool in the trade war?
I'm not. I think that 10 years ago, that was a much bigger weapon, but it's just something important for people to realize. These foreign governments hold all these treasuries. Well, if they start just trying to sell them willy-nilly, they're essentially destroying the value of their own holdings, too. So I don't think that they are going to willingly sort of see their assets be destroyed just to get at the United States. I think that yesterday's 10-year auction was very important. There was solid demand there. Yeah. And I think that people are looking at this hopefully now as they should. This is a moment in time. It is going to have some repercussions in the short and medium term, but over the longer term, we should get back to business as usual.
All right, a soothing overview for bond investors, Tom. Thank you so much. Really appreciate it.
Thank you.
Coming up, oil prices under pressure as trade fears continue. We'll discuss what it means for the industry next on Catalyst. Oil prices resuming declines after a brief rally on Wednesday as investors worry about the fallout from trade tensions between the U.S. and China. Prices are down roughly 8% since the start of the month. So here to discuss the recent declines and where we're heading in the energy market, Rob Thummel. He is Taurus's senior portfolio manager and managing director. Rob, great to have you here. These tariffs and the 90-day pause, the 125% on China, where does that tell you that the energy market is heading next?
Yeah, so the U.S. and China are the largest consumers of oil in the world. And so obviously tariffs would imply that we potentially will have an economic slowdown. How severe it is? Well, we're going to find out. But oil prices and oil demand and GDP growth really go hand in hand. So if there's a slowdown in the economy, there'll be a slowdown in oil consumption. So oil prices are indicating clearly we're going to have a slowdown in consumption. And maybe the oil markets might be oversupplied at the current time. So that's kind of where we're headed right now.
What do you think about the argument that people are making that, well, now oil prices are down, that's going to boost the consumer, and this is an offset to tariffs?
That, the solution to low prices, as you said, Stephanie, is low prices. And that's exactly what's happening, right? So that will be an offset. It takes a little while, but that is the positive of all this low oil prices, is us as consumers, gasoline prices are lower. Some other, oil is a commodity that's used in a lot of consumer goods. Those consumer goods will be a little lower price potentially because of oil prices. So yeah, that will boost demand down the road. And it's a good question. It always offsets. It just has to be, what's the degree? What's the severity of the decline?
And this is what Treasury Secretary Scott Bessent wanted, was these low energy prices and low yields on the 10-year in particular. But Rob, is there a point where the pain tips over into being a negative?
Well, it does for the producers, right?
Yeah.
And economy. So the oil price, a lot of people look at the oil price as kind of an indicator of the global economy or what's going to happen in the future in the global economy. And with oil prices so low, I think a lot of people feel like, oh my gosh, there's an impending recession or something where we're going to approach that. Definitely slower economic growth. Oil and gas producers, though, are the ones who get hurt the most because they have commodity price exposure, right? Their cash flows are tied to what the commodity price exposure is. So lower oil prices mean lower revenues, lower earnings, lower cash flow for these companies. And so that's why you're going to hear a lot of them here on these first quarter calls probably reassess how much money they're going to invest in oil and gas drilling for this year and definitely probably next year because of the current low oil price environment.
How do you think about that relative to the administration's goal of boosting production? Are they going to actually be able to achieve that?
Yeah, well, the good news is oil and gas production is still up and will probably still rise again this year. Maybe not just as much as everybody thinks. I think about the administration's goal a little bit differently in that the goal is to keep prices low. Now, we can debate what are low prices. I think $50, $60 oil is a low price. What the administration wants is, I think, doesn't want oil prices going $80, $90, $100. Well, the U.S. oil and gas industry has ample capacity to ramp up drilling capacity and expand production even more if prices go much higher. When they get below 60, though, I think the industry will be maybe a little bit at odds with the administration, but that's where the industry thinks the prices are, quote, low.
And how does this play out in terms of countries that are allies of the U.S. banding together with countries that are typically on a little bit more of a strained relationship with the United States? How does that dynamic impact the oil market? If we see the likes of Europe and China, we've continued to have sources tell us they're not going to partner up necessarily, but if we do see that relationship coming a little bit more friendly, how does that impact you?
Do we have an hour to talk about this?
Yeah, it's a lot.
You want to do 30 seconds,
30
right?
30 seconds, yeah. Just explain global trade wars.
Obviously, you're talking about geopolitics, Madison, and this is where it gets really interesting. So if you look at the biggest consumers, China, Europe, India. Obviously they want low oil prices as well, and demand will be fairly steady there. OPEC, obviously, Saudi Arabia, are they a friend or a foe? I think they're probably generally a friend, but they're raising oil production, right? Well, so long story. The short story is simply, look, supply demand in the oil markets is always changing. But what we think could happen, what nobody's paying attention to, is the fact that the oil supply actually could maybe be lower than what people think globally for two reasons. Number one, there could be sanctions on Venezuela and Iran that will actually reduce the amount of oil supply in the current market. In addition, OPEC Plus, Saudi Arabia just raised oil production, but they partially did that because they want Kazakhstan, Russia, and Iraq to lower their production. And so the net of all of this is the surprise could be actually less oil supply added to the market. And when the market is thinking we're going to have excess supply, we could actually be undersupplied. We'll see how that plays out in the next 6 months.
Yeah, certainly an interesting dynamic to follow. Rob, thank you so much. Thanks for coming in the studio. Appreciate it. We're going to have all your markets action ahead here on Yahoo Finance. So stick around. You're watching Catalysts. While most investors looked for clarity about where President Trump's trade agenda was heading, our next guest accurately predicted that Trump's tariffs were really all about China. Joining us now, David Wu, a former top Wall Street global macro strategist, current CEO of David Wu Unbound, where David publishes his research. And David, you accurately predicted a few days ago that the entire trade war would be about China. What is your message to investors about where we head from here then, given that clarity?
I think that's the thing. I think, the point here is that not only I think this whole entire trade war, the prime target was China, but rather I think at this point, I think it's safe to say that the entire trade war has been designed by the architect of the Trump's trade war to literally deal a blow to the Chinese economy so hard that China will no longer be able to threaten the U.S. hegemony. In fact, if you think about this, 125% tariff, I mean, if we were to apply the sort of the traditional estimate on the price elasticity of imports, okay, this would suggest that with this tariff, Chinese exports to the US will go to zero. We're not talking about down 30%, 40%, will literally go to zero over time. So I think from that point of view, there's no doubt. I think the Chinese are waking up to this realization, which is that this is not just a trade war, that this goes way beyond it. And I think my view is that the DeepSeek news, in many ways, 2 months ago, have only galvanized the China hawks in Washington who believe that literally that China is an existential threat that has to be dealt with urgently. And I think these people right now, no doubt, are in the driver's seat.
So David, what investment thesis does the scenarios you just laid out create?
I think right now, obviously, there's no doubt. I mean, there will be several rounds. This very first round, I would say Trump won. No doubt about that. Especially given, I think Trump has success. If there's one success we can attribute to Trump, is the fact he's actually isolated China. The fact is that today, as you know, the European Union has basically decided to postpone the imposition of the $26 billion tariff that they only approved yesterday by 90 days. Okay? And moreover, Japan and South Korea have denied that they were ever in negotiation with China about basically doing a free trade zone. Okay, even Brazil and India that are members of the BRICS have basically come out essentially closing the door on cooperation with China, so on and so forth. So I would say China definitely is very isolated at this point. The question then is, what does China do? Because I think Xi Jinping right now has only two choices. Either he accepts defeat and sue for peace, or he really steps it up and tries to punch back in some other way that's not economic. Okay, but I think that's really the issue. And this is the reason why gold price has done so well, because I think the consequence of this trade war is that geopolitical risk has risen sharply.
So David, what does China do next to retaliate? What are their options?
I think there are several options, none of which is very pleasant. But let's just think about it. I think in economic realm, they don't really have many options, right? Because even when it comes to like selling treasuries, I mean, let's be honest, most of central banks' holding of treasuries are held at the New York Fed. I'm telling you, at the first sign that China's trying to liquidate their treasury holdings, I mean, China run the risk of having their holdings being frozen by the New York Fed or by Trump and so on and so forth. And they know that. So that's not really the thing to do. And then also because, I mean, Chinese imports from the US has been falling over the last 5 years. So that even today, like China only imports about 20% of US export of soybeans. Okay, so even there, I would say China doesn't have that much leverage. Again, I'm thinking in geopolitical terms what China can do to potentially hurt the U.S. I think one country that comes to mind, obviously, is Iran. As you know, the U.S. will be meeting with Iran, okay, on Saturday. And Trump says that he's optimistic that the two countries are moving forward in terms of averting a U.S. bombing of Iran's nuclear facility. As you know, China is Iran's largest oil, basically importer.
Right.
Back 99% of Iranian oil goes to basically China. China has a security agreement with Iran. China is Iran's arguably biggest backer. If I'm China right now, I might not want to I want to basically bolster Iran's back in order to basically use Iran as a leverage in my negotiation with Trump. So I would argue, all else being equal, I think the situation between US and China today means less likely that you're going to see the Iranian signaling any kind of willingness to negotiate with Trump this Saturday, which I think is bullish for oil and for. I think
David,
the other, of course, is Taiwan.
Sorry to interrupt you, but we've got 30 seconds left, and I want to get your picks for our investor audience listening. How should investors be investing off of the ideas that you're laying out? 30 seconds.
So I like gold. I think gold could potentially go even higher because I think a lot of central banks are going to be diversifying out of dollar into gold. That would be the right thing to do. I think the second thing is I think defense stocks are going to be very attractive. As you know, like I think as the China hawks, the Russian hawks, essentially make a comeback in Washington, already Senate and in the House, both want to increase defense spending. This is very bullish for defense stocks. Thirdly, if you really like the idea of basically reshoring of U.S. manufacturing and so on and so forth, I think something like a Rockwell, ABB, which are sort of leading providers of automation in manufacturing, I think are pretty I think will look pretty good, at least on a medium-term basis.
David, thanks so much. Really appreciate you making the time for us and for giving us your insights. Coming up, we got Wealth, dedicated to all your personal finance needs. Brad Smith has you for the hour, and a huge thanks to Stephanie Roth from Wolf Research for joining us for the hour.